understanding past performance and current performance is important, but all investors accept that past performance is not the most effective lens through which to determine future performance. This is well understood. It's not a revelation. But when considering past performance, what investors are most concerned about is the sustainability of that performance and the probability that it will continue. Equally, we want to understand the probability that performance of a business going forward could be better or in fact worse. Looking at business performance through an intangible asset perspective focuses our attention on aspects of the business which are critical to future performance, but which are not accurately reflected in financial statements or typical business disclosures. When investing through an intangible asset lens or perspective, we give disproportionate weight to understanding the quality and strength of a business's intangibles, which includes, among other things, contractual rights, designs, patents, software, data, trade secrets such as formulas, recipes and methods, networks and relationships, brand, culture. These intangibles are the primary driver of business value. They typically represent up to 90% of a company's shareholder value, but they rarely show up on the balance sheet, and when they do, values are often incorrect and fail to identify any component parts of intrinsic value. When investing through an intangible asset lens, we give priority to understanding the value of these assets. Simply put, intangibles represent nearly 90% of a company's shareholder equity value, and we give commensurate amount of time to understanding these assets. An effective understanding of a business's intangible assets enables an investor to do two things. Firstly, an effective understanding of intangibles provides a clear view on the component parts of value which underpin performance. Secondly, an effective understanding of intangibles provides a clear view on the ability for performance to be sustainable into the future, or perhaps even better or worse. In the same way that we might apply a specific methodology or process to valuation of physical assets, each category of intangibles needs to be assessed appropriately. By way of example, the existence of a granted patent does not mean that the patent is relevant or even valuable. Effective assessment of this type of intangible asset entails a detailed review of the patent claims and all relevant prior art, which must then be contrasted against the form of technology, the addressable or target market for commercial use, and the capabilities of the business to penetrate their market. More often than not, effective assessment of intangibles requires a multidisciplinary skill set, including input from legal, strategy, and technical professionals. As a result, there is significant latent value and risk in many businesses resulting from the lack of measuring and managing intangible assets effectively. And so investing via an intangible asset perspective means that investment decisions give priority to understanding and assessing the quality and value of a business's intangibles. Put another way, investing via an intangible asset perspective de-risks investment decisions by identifying the source of value, measuring and quantifying this value, and more effectively assessing the potential that such value can or will persist.